Hi everyone, this is Jason Burack of Wall Street from Main Street. I've been getting a lot of comments underneath our YouTube videos, also emails to our Wall Street from Main Street at gmail.com and other correspondence through social media of people asking me to give them their favorite junior mining stocks, talk about shares Mo Dawood and I own in our portfolios. I don't want to name all the companies we own in our portfolios. I've named those throughout the year, so if you've been paying attention on some of the comments or other interviews we've done, we do that. I'm not going to go through videos and name every single one I own all the time, but I just want to show you guys, though, some of the problems with owning juniors and why I think most regular retail investors, people on Main Street, should not actually own any individual junior mining explorers or junior mining companies. There are ways to play juniors more carefully without taking on too much risk, and where you can still get good reward, but you can also reduce your risk. One of the things about junior mining companies is there's so many, whether they're explorers or they're building out a resource or they're close to getting financing, they have all the drilling done, they have all the preliminary economic assessments done, the pre-feasibility, they've gotten their permits, they're going to the bankable feasibility study. There's still so many things that can go wrong. There is an article here by Itinerant. I guess that's his name on Seeking Alpha. He's a pretty smart guy when it comes to the resource sector. He has a lot of experience. I don't agree with him on everything. Him and I have had some arguments about certain things, but I think this article is a very valuable one. This article I'm going to link you guys to. It's called Resource Sector Digest. He does this a couple times a month, I want to say. He releases an article like this. He co-writes this with another research analyst on Seeking Alpha. Another one bites the dust. So in this article, he talks about a resource stock where Sandstorm Gold, they had to do a 31% revision of the company's in-ground gold, their resource. So they just announced this, and look at the stock price. It was doing very well with the gold price, and then it crashed. That's one of the problems with juniors, guys. Even if this newsletter writer knows the management team, there's a long list of things that can go wrong. Probably more than 10 things that can go wrong with a junior as they're starting to build the mine. Even when the mine's built, things can go wrong. I've been investing in companies in the past, and I've been able to get out and cut my losses, but I have lost on a percentage basis, large percentages. In a matter of days, 1 or 2 days, you could have, if something goes wrong with a junior, because oftentimes they only have one asset and they've had to basically bet the whole company on one asset, you could have the stock drop 30% or more in 1 or 2 days. You could have just an enormous drop. And, within 6 months or a year, the stock could be down 70-80%. While the gold or silver price screams higher, if bad things happen at the company, there's so many things. So let me name some of the things. First of all, I think you guys should read this whole article. So he's talking about the problems with this one junior at this part of the article. He also talks about Rubicon Minerals, which Royal Gold did a gold stream deal with Rubicon Minerals to build their mine, and then they had to restate their grades. They had problem with grades and drilling there. So they had to reduce their resource by 90% earlier this year. And mining the deposit seems all distant. Look at the share price. The share price went from almost $1.10 on the Canadian exchange down to 6 cents. So this is the things that can happen with the junior miner. Even if the project looks good on paper, there's still so many things, the financial stuff, even if it looks low cost, there's so many things that can go wrong. If it's an underground gold mine, the rocks could cave in. That's happened to me with a producing copper and silver mine called Revit Minerals. They had the Troy mine up in Montana. The mine, when copper and silver were at a high price, the mine had a cave in with rocks and had to shut down. Company couldn't raise any money. They had debt. It was a disaster. They were able to sell out. I think they avoided bankruptcy, but they had to sell the company. Literally, the stock dropped. I think in a year and a half, the stock dropped like 99%. I was out of the stock by then, but they sold out to Hecla. They sold all their assets for pennies on the dollar. And, the mine had been running for a while, and then there was cave-ins with the rocks. There can be flooding at the mine. If the mine is an underground mine, there could be problems with grades. So the mine is already built and constructed. All the capex is laid out. The miner takes on massive amounts of debt. And then all of a sudden, the grades that were relied upon for the mine to be economic, the grades are not as good. That's happened with companies, at least temporarily, like Metnor. The Metnor management team, I don't want to pick on them too much, although, you know, they have destroyed their share structure. That's another problem. You have the management team that, you know, when the gold and silver price are high and the share price is high, they don't want to raise the capital that they know they need. They think that they can raise it later on. They're hoping the gold and silver price goes higher, and then so they wait. And then the gold and silver price doesn't go higher like we had during the bear market, and then, you know, they just diluted the hell out of the shares. So there's also a lot of management teams that are overpaying themselves. You can go in there and look and see how much salary the management team. You have to look through the annual report. Sometimes you might even have to contact the investor relations department, and you can check what the management compensation is, both in cash and salary, and also in share compensation. Sometimes these guys, no matter what the company does, even if the company does nothing, they're getting paid massive amounts of shares that they're dumping on the open market to pay their bills. So this article, guys, I really think it's important. He's mentioning a number of other juniors with problems. Midway Gold. Another one that I also owned at one point was the Shafter, which is Shafter Mine, which is Arcana. You know, they were signed off, he's mentioning in here, by a very experienced geologist. So I don't know if you guys listening to this are geologists or you have friends who are geologists, but for the individual retail investor, it requires an enormous amount of mental toughness and fortitude and the ability to not panic in some cases, or to understand what the facts really are. Sometimes, you know, if you don't have a geological background and you don't know the project economics of the mine, you could hold on to the shares and the shares just keep going down and the company's in trouble. Either they're going to go bankrupt or sell for pennies. There could be another case where the market just overreacts. So I think there's ways to reduce this risk for people who want junior exposure to protect their downside a little bit more. And one of those ways, because we don't know what we don't know, especially with junior miners, is diversification. And one of those ways to get diversification while still getting exposure to juniors, I'm going to talk about in the rest of this video. One of the ways, and this is my largest holding, is Sandstorm Gold. Sandstorm Gold has 20 assets now generating cash flow. They have junior miner exposure. They also have good counterparties like Yamana Gold and other large mid-tier and senior producers like a First Majestic Silver and so many others. So they have 20 assets generating cash flow in their portfolio. They are diversified. They also have exposure to other juniors. So they either buy royalties on royalty packages that are available, or they will buy an individual one royalty where they don't have to put any more capital expenditure in, and they could generate like a couple $1,000,000 a year if the mine gets into production. So that it's not as much risk when Sandstorm is building their portfolio together. They don't have to bet the whole company for the most part on one deal anymore, just like not just like, but like what a junior miner would have to do when they're building their one main mine. So there's so many things that can go wrong, guys, with junior miner building the mine. The permits can be pulled. The government, if it's the best geology now, guys, for a lot of mines is in politically unstable countries. You know, like Argentina has excellent geology, Bolivia has excellent geology, and there was situations like with Bear Creek Mining where on paper Bear Creek Mining had two excellent mines, the Santa Ana mine in Peru and also the Corani mine, and their original business plan with the Santa Ana mine was to build that mine first. It was a smaller silver mine, but pretty solid grades and good economics. And then all of a sudden, the president who was leaving Peru due to political reasons, he pulled the permits, and that destroyed the company. So on paper, you know, you look at the geology and the economics of the mine, and then all of a sudden the politicians change the rules. So for the retail investor who can't afford that many losses and doesn't have a lot of capital, you know, buying junior miners and hoping to get rich buying an individual junior miner is very risky. So Sandstorm Gold would be better than buying an individual junior miner like, say, Bear Creek. Now, the upside might not, well, I think the upside for Sandstorm Gold will be a lot, but for some of these other ideas that I'm going to mention are not. You have Sprott Incorporated. So Sprott Incorporated, everyone's heard Eric Sprott and John Embry and a lot of the other guys from Sprott. What they don't know about is that Sprott Inc. is publicly traded on the Toronto Stock Exchange, and they get private placement deals on juniors. They have a team of geologists that have a lot of experience. They go and look at properties. They do private placements for these juniors. They're very selective. You have Rick Roll and others looking at the project economics. They're not always right, but they have a really good investment checklist that a lot of retail investors just don't have access to. They don't have access to the resources. They don't have the money to pay for all these different junior newsletters. They can't hire all these geological consultants. Sprott Inc. does that. You can get almost a 5% dividend yield with Sprott Inc. We have this as a core portfolio position for our precious metals model portfolio for our paid consulting clients who want to learn how to invest safely in gold and silver. I think Sprott Inc. is a very underrated company. They don't have any debt on their balance sheet. They have diversified sources of cash flow and income, and they get those private placement deals with juniors that guys like you and me who are listening to this video, a lot of Main Street guys, we can't afford yet. Someday, guys, I'm going to be rich. I know that. I work my ass off in order to be successful in life, but I can't afford private placement deals right now. I'm not like, the Rick Rolls and the Eric Sprotts. I can't go in and buy 10% of the company, but I can safely invest and get exposure to juniors with Sandstorm Gold. Sandstorm Gold has over 90 other royalties and streams that are going to come online potentially in the future. Not all of them will necessarily, but those are potential lottery tickets that are optionality in their portfolio that the market is not valuing the Sandstorm stock at, plus Sandstorm Gold has earnings and solid cash flow. So Sprott Inc. is kind of similar in that regard. You get paid to wait, though. So you're getting paid almost a 5% dividend yield. This is in Canadian dollars. A 5% dividend yield paid to wait, while Sprott Inc. does the research work for the juniors. And they also, collect the fees on their Sprott Physical Gold and Silver Trusts, and they have hedge funds that trade resource stocks. So this is a over $400 million company that has good exposure to gold and silver and good cash flow, no debt on the balance sheet, and a dividend. So this is a safer way to play juniors rather than going in and speculating and taking on massive amounts of risk and hoping you get lucky on a lottery ticket, and potentially, while the gold and silver price goes up, the individual company stock could crater because the management team did something wrong, or there's a problem with the geology, or the grades weren't as good as the project economics said. There's just so many things that can go wrong with an individual junior mining company, and the junior miner, for the most part, they have to bet the entire company on the mine. They have to go, to use a poker analogy, they have to go all in. And if things go wrong, if there's any problem, if the mine, constructing the mine, if it's not on time and on budget, and there's huge cost overruns, the share price is going to get hit, and the company could potentially get bankrupt very, very quickly, or it could get bought out for pennies, which is not good for shareholders either. So the other ways conservatively to play juniors. There's 3 junior mining ETFs. These are a basket of juniors. They will not go to zero. They will go down a lot if there is a correction in the paper gold and silver price, but they won't go to zero. And you could hedge your position with options. You can hedge your position with this if you want to. So there is good upside in this, and retail investors should strongly consider, instead of buying individual junior miners or explorers, they should strongly consider these 3 ETFs I'm about to mention. So you have the Van Eck Vectors Junior Gold Miners ETF. That's GDXJ. You can go look that up. So this is a way to play juniors safely. Another way to play juniors safely, this is a newer ETF, the Alps Sprott Junior Gold Miners ETF. There's also a regular Sprott Gold Miners ETF. Those are with larger companies. So these are safer ways. These are a basket of juniors. Rather than betting all in on 1 or 2 or 3 or 4 or 5, you're getting a basket of these things. You're getting exposure. You can also hedge your portfolio exposure to this. The other one is, if you want more exposure to silver, Andrew Chain and my buddy over at Pure Funds, this was actually his first ETF he came up with. He had a line of other commodity ETFs he was going to launch, but then there was the commodities bear market. So this is the only one in the commodity space he kept. He's doing technology ETFs, which are really good, but he's really a gold and silver bug, Austrian School Economics. So, he did a successful pivot and he built a nice business, but this was his first one. Now he has Hack, which is the cybersecurity ETF, and he has the video game ETF and the big data ETF and the drone and mobile payment ETF. So he's doing a good job giving people diversified exposure to technology. For the retail investor, I also recommend thinking about those technology ETFs. If you don't want to pick out individual companies, you will get exposure to those long-term trends where in those individual technology industries, there is still potentially 8 to 15% per year growth in revenue growth from those companies. And those companies have disruptive technologies. So you have the Junior Silver Miners ETF. The other one, the other business model, And the upside is not quite as large unless there's a spinoff or a special dividend. And a spinoff is with shares. So once in a while, a company like Almaden Minerals, there's the prospect generator model. So you guys, I'm going to attach a few different articles for you guys to read about the prospect generator model who are not familiar. It's a team of geologists. Normally they specialize in certain types of rocks or certain types of countries, the geology there. And larger companies give them some cash, larger mining companies who have cut back on their exploration staff, but they outsource, they farm out the ability to look for deposits. So they will give companies like Almaden Minerals, and there's a handful of others. I think maybe there's at least a dozen of these other prospect generators, although some of them have gotten bought recently. But basically, these guys will do the drilling on their own. They'll do a small amount of drilling. Maybe they'll hit a couple good drill holes, or they'll do a small resource estimate. And then once they do that, they can sell the deposit and keep a royalty on it for cash flow. So then they can use that royalty for cash flow, which is maybe a couple $1 million if the discovery they made turns into a cash flowing mine. They can use that to reinvest, either to pay out dividends to shareholders, or they can go and reinvest those profits, plow them back into the business, and spend it on more exploration. And over time, if they have a number of royalties and they have a number of winners, they can also, the shareholder value is really, really good. Now, it's not going to be as good as an individual junior miner who drills out all these holes. There's some luck involved too, finds a mine, takes the mine all the way to production and cash flow, builds out a mine, and makes enormous earnings. But the odds of that are pretty low. And like I've tried to outline in this interview, there's just so many things that can go wrong, from raising the money, starting the drilling program, all the way to doing the resource estimate, financing the construction of the mine, and then actually getting the mine up and running at the projected economics and trying to generate free cash flow. Even after the mine's in production, guys, there's producing mines that have accidents. So if the company has a couple other mines, like Yamana Gold even had a problem with one of their producing mines, I think the Chapada mine. And Yamana Gold has, I think, more than 6 large gold mines that are producing. But one of their lowest cost mines, the Chapada mine in Brazil, I think, had a problem with the crusher. So they had to temporarily, drastically cut the production, shut it down. The stock price took a hit, but the company's not going to go bankrupt. So the company's going to survive. But with a junior miner who only has one asset maybe generating cash flow, or they betted the whole company on getting the mine into production on time and on budget, and on the project economics that, we're going to produce this much ore at this grades and these costs, there's just so many things that can go wrong. And even the large miners have problems bringing a mine online. So hopefully you guys will learn some things from this video. I will attach, besides this Mickey Fulp article about the prospect generator model, I will attach some of the other articles I see for prospect generators. But these are ways for people to have a safer approach to playing juniors. Maybe your upside is somewhat limited, but your downside, your risk, is going to be less than it would with putting a heavy position into a junior. So even if you pay for different paid newsletters, and these guys have a geology background, they have a successful track record of picking winning stocks, there are still things that can go wrong that are unexpected that people didn't see. There's lots of projects out there where very experienced, successful geologists and investors have signed on to the project thinking it would be a success with an individual mine in a certain. Normally, it's not a geopolitically safe country, but there's still been flooding at mines in Canada that are underground. Look at for uranium with Cigar Lake, which is underwater. That deposit was underwater. So even the large companies have problems, and normally the large companies, they don't go bankrupt if they have a couple other mines online generating cash flow from one mine that's shut down or delayed. But junior, the mistakes are compounded. So I don't think, for a lot of you guys out there, I don't know how much money all of you guys have, but it's just not worth it in a lot of cases to put a lot of money into an individual junior explorer or junior producer or company that's in the process of building a mine. There's so many things that can go wrong. I would rather do it, for me at least, I sleep better with more diversified exposure. For disclosure, I own Sprott Inc. I own a good position in Sprott Inc. I sleep better at night and I own a lot of Sandstorm Gold. So I think those are good ways. There's other smaller royalty and streaming companies than Sandstorm Gold that are looking at doing a business model similar to that. but Sandstorm Gold has a lot of growth in the pipeline and a lot of cash flow. And I think hopefully if Sandstorm Gold is not bought out, I don't want them bought out because that's going to limit the upside of my capital gains. But 4 or 5, 6 years from now, Sandstorm Gold is going to maybe have 35, 40 streams potentially. They should be definitely. They have 20 now. They should probably be over 30 in 4 to 6 years for stream, maybe 5 to 7. They have just an enormous amount of optionality. Now, a lot of that is dependent on the gold price, though. But if the gold price does fall, Sandstorm Gold has more insulation because they have their cash flow diversified. Okay, guys, well, I hope you learned something useful from this video. I have an interview with Jim Willey coming up this week. I definitely think you guys should read this itinerant article, the Resource Sector Digest, Another One Bites the Dust, and he talks about the due diligence required for juniors. A lot of you guys are just putting speculative capital into the juniors. I don't know how much due diligence you're doing. Some of you guys I see post on Facebook. I think you're just looking at the chart and you're chasing it higher. If you're going to do that, you have to have some stop loss limit orders for your juniors, because there's a lot of things that can go wrong that the chart's not going to give you hints about that are going to potentially go wrong at the junior mining company. So that's it for today right now, guys. Everyone have a great week, and occasionally I will do videos like this in the future, but since so many of you guys have been asking for my stock picks for gold and silver juniors, I thought I would do this video to show you guys about risk and reward and how I think about things, because there's just so many variables that a lot of people can't fully account for. I mean, I could write down all the things, a list of problems that can go wrong with a junior miner building the mine as it goes into production, and I still probably haven't thought of a number of the variables that could potentially go wrong. Even if the junior miner crosses off a lot of the things on the checklist, there's still potentially hurdles that could sidetrack the mine from coming on time, on budget, and generating free cash flow. Okay, bye, guys.